At this point in our study of finance, we have covered some fundamental issues, including simple and compound interest, savings accounts, and loans, how to save for retirement using an annuity, and how to calculate a car payment. In Section 8.7, we're also going to cover an important topic that you may experience in your everyday life. 8.7 deals with the cost of homeownership. Now, if you've ever purchased a home before, you know the process can be a little bit complicated. So before we jump into the mathematics, we're going to make sure that we understand the terminology associated with this process. Buying a home is a big responsibility. One should plan wisely to be prepared for costs associated with home ownership. Because homes generally appreciate in value, a little different than cars. When you buy a new car, the moment you drive it off the lot, it begins to depreciate in value. However, homes generally appreciate in value. So purchasing a home can be a very wise investment. Essentially, when you buy a home, as the landscape matures, as school systems are added, the price of the home increases. So if you were to turn around and sell it, you would earn a profit on your sale. At the point of sale, there are closing costs one must prepare for. These include a down payment, possible points, we'll define that here in a minute, required by the lender, and possible realtor fees. Again, those costs occur at the point of sale, but throughout your home ownership, there are other costs that you may run into. In addition to the monthly payment on a home that has been financed, additional costs associated with home ownership include real estate taxes, homeowners insurance, and potential mortgage insurance for different types of loans. Those costs are generally added to the monthly loan payment so that they can be covered throughout the year. And finally, homeowners must budget for utility bills, regular home maintenance, and unexpected repairs. It sounds like a lot, but understanding what you're encountering when you buy a home can help you to be better prepared for it. Now, let's talk about some specific terminology. Closing costs are amounts charged to the buyer at the point of sale of the home. These may include a down payment, lender points, and realtor fees. So when you actually take the keys to the home, the closing of the deal, that's when you will be paying your down payment and possible other fees such as lender points and realtor fees. Now, a down payment is a lump sum paid toward the price of a home or car on which no interest is charged. Because you pay that cash at closing, you are not charged interest. Your down payment goes directly for the house. It does not go to the lender. The higher the down payment, the better it is. The higher the down payment means the less you actually have to borrow from the lender to pay for the home. Next definition. In addition to a down payment, some lenders require the buyer to pay points. A point, that's just code word for 1% of the mortgage amount paid by the owner at closing. So if your particular lender charges 1% or 1 point, that means at the point of sale, at closing, when you take over those keys, in addition to your down payment, which you're paying cash for, you will also pay cash for these points. Again, fees paid to the lender for their services. Now, a mortgage is a long-term loan. That is between 15 to 40 years, taken out for the purpose specifically of buying a home. Now, we're going to see that the way we calculate a house payment is exactly the same way that we calculate a car payment. The formula is one and the same. But a mortgage is specifically named so that it covers this long-term possibility, and it's for the specific purpose of buying a home. Associated with that word, we can say a loan is amortized when part of each payment is used to pay the interest and the remaining part is used to pay the principal. We covered this briefly when we talked about car payments. Car payments work the same way. The amount that you pay for your loan each month does not change, but the way that payment is proportioned changes month to month. Part of it goes to actually reduce your debt to pay for your principal, and then the other part goes to interest. Now, an amortization schedule is a table showing how much of each payment is applied to principal and how much is applied to interest over the term of the loan. Oftentimes at closing, the lender will give you a complete amortization schedule. That is, they show you a table of every payment that you will make on that home and exactly how much will go to interest and how much will go to mortgage each month. As time progresses, the amount applied to principal increases. And as your debt decreases, the amount that applies to interest decreases. Now, we're going to talk about some strategies at the end of this section that will help you to avoid paying some of that interest on your loan. And finally, an escrow account is an account used by the lender to pay real estate taxes and homeowners insurance. So in addition to your monthly payment, extra fees will be tacked on to that monthly payment, and they will be set aside in this escrow account and saved up for when real estate taxes are due and when homeowners insurance is due. This helps you to spread out those costs over the year so you're not facing big lump sum payments a couple of times per year. So this is the terminology associated with homeownership. In the next video, we'll go ahead and get started on the mathematics.